The thing about AI for business, it may not automatically fit the way your business works. At IBM, we've seen this firsthand. But by embedding AI across HR, IT, and procurement processes, we've reduced costs by millions, slashed repetitive tasks, and freed thousands of hours for strategic work. Now we're helping companies get smarter by putting AI where it actually pays off, deep in the work that moves the business. Let's create smarter business. IBM.
Support for the show comes from Public. Lately, it feels like there are two types of investing platforms. Some are traditional brokerages that haven't changed much in decades, and others feel less like investing and more like a game. Public is positioned differently. It's an investing platform for people who are serious about building their wealth. On Public, you can build a portfolio of stocks, options, bonds, crypto without all the bugs or the confetti. Retirement accounts? Yep. High yield cash? Yes again. They even have direct indexing. Public has modern design, powerful tools, and customer support that actually helps. Go to public.com/market and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/market.
Ad paid for by Public Holdings. Brokerage services by Public Investing. Member FINRA SIPC. Advisory services by Public Advisors. SEC registered advisor. Crypto services by Zero Hash. All investing involves risk of loss. See complete disclosures at public.com/disclosures.
Small businesses are the pulse of every community. They bring people together, create opportunities, and drive growth. Chase for Business helps business owners like you with personalized guidance and convenient digital tools all in one place. With that guidance and your determination, you can take your business farther and help build a brighter future for your community. Learn more at chase.com/business. Chase for Business. Make more of what's yours. The Chase mobile app is available for select mobile devices. Message and data rates may apply. JP Morgan Chase Bank, N.A. Member FDIC. Copyright 2026. JP Morgan Chase & Company.
Welcome to Inside Active, a podcast about active managers that goes beyond sound bites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. So we all know active ETFs are now one of the fastest growing segments in asset management, and with fixed income ETFs being a large part of that. In addition, 10,000 Americans are reaching retirement daily while trillions sit in retirement accounts. And we're also seeing growing demand for predictable income and outcome-oriented solutions as retirement accelerates. So to help us unpack what this means for active management inside the ETF wrapper, we're joined by Dave Abner, who is head of global ETFs and funds at Northern Trust Asset Management. Dave, thank you for joining us.
Thank you so much for having me on, Dave. It's great to be here.
Let's start with, so 2 years ago, you stepped into a role that spans both mutual funds and active ETFs. How do you think about where active belongs in each wrapper, especially given Northern Trust's heritage as an institutional manager?
Yeah, thanks. It's a great question. Actually, the role is very unique in the industry too. I think I'm one of the few ETF sort of legacy ETF people. I would say I was here from the very beginning or very early on to be overseeing a mutual fund business as well right now. So it's in a way I've kind of gone back. Like I learned about mutual funds as an investor early on, but then I got very into ETFs, and everything I learned about mutual funds over the last few years was really through the lens of ETFs. And now I oversee both businesses. So it's really been it's been a great learning experience, and it's given me a lot of ability to think about where active belongs in each wrapper. And I really don't. I'm kind of product or wrap. I like to say I'm wrapper agnostic, right? When investors come to us at Northern, we first start and we think about like, what are they trying to achieve? What outcome are they trying to, generate? And then we think about what is the most appropriate wrapper to achieve that outcome, right? So that's so, from my seat, whether you want to buy a mutual fund or an ETF, if we think it's the right investment vehicle for you to get that outcome in, we're happy to, deliver it, right? Then when I go beyond that, do I think active belongs more appropriately in one wrapper or another? No, I don't. I really don't. I think I think you have to. It's less about the wrapper and it's more about the requirements of the strategy itself, right? Like you don't want the wrapper to be a constraint. Um, if I think about ETFs and most ETFs have a need for daily transparency. If that will constrain the strategy, we may be better off launching the strategy in a mutual fund. So there's sort of a list of things that I think about regarding wrappers when we're thinking about which way to wrap strategies. And for the most part nowadays, I mean, people are coming to us and really asking for the ETF wrapper, investors, right? Advisors in particular. They just, ETFs have I think we're sort of hitting that hockey stick moment. I'm sure we'll talk about it. And demand is like they're sort of they're the desired vehicle. Sometimes even if it's not the right wrapper, but they still want an ETF.
No, it makes sense. I was, I've been covering ETFs forever too, and with my role as a mutual fund analyst, I have to cover active ETFs too, because I
Yeah.
mean that's where the future is. When you look at kind of the core active products Northern Trust has historically offered, I noticed you got the Flex shares on the Vest on, and there's legacy funds like GUNR. What lessons from their performance and like investor reception kind of inform your active product roadmap today?
Yeah, it's a great question. So you're right. You meant so we're it's funny. Northern Trust, the ETF business is actually going through a little bit of a transition. So we were Flex shares and we have been Flex shares and we have the Flex shares suite of ETFs. And we also recently launched the Northern Trust ETFs. And we've announced that this year, at some point later in the year, we'll be merging the Flex shares brand into Northern Trust. It won't change any of the ETFs, but it'll be easier for us to have conversations like this because it'll be one brand. It'll be the Northern Trust ETFs. I think the business has changed its view, partially because there's new leadership, me coming in, but also partially because the industry changed dramatically, right? Like 6C11 really changed everything for active ETFs. They really were not uh, easy to do. We actually have two active ETFs, RAVI and BNDC, and those were launched under our FlexShares brand years ago. Those are the only active ETFs we have. Actually, Gunner is an index-based ETF. Um, but when we launched those, we were thinking the only way to bring these strategies to market in an ETF wrapper was active, right? There was no way to really index size them. But now, if you think about what 6C11 did, it changed what you can really bring in the active wrapper. So you see today, and then we'll talk about some of our new funds, distributing ladders are active. ETFs in general, this sort of renaissance of active, and you know this, like 5 or 7 years ago, we were talking about the death of active, right? Like active is dead, passive is growing, and now you're seeing, and I think it's a result of 6C11, this sort of what people are calling the rebirth or the renaissance of active. And again, it gets back to that sort of, can you bring the strategy to market and what are you trying to give to investors? I, I really think what you can do with active ETFs today is enabling this renaissance, but it's not the same active that we used to know. And to me, that's important, right? Like we used to talk about active and it was like Peter Lynch or, any of the legends of active investing. Today, active means something very different, right? Like it's like, can we use the active wrapper to bring a strategy to market for investors that may be even sort of not active the way you think about it, but is not tracking an index, and that's that differentiating piece. Like it's become complicated, I think, for investors in a lot of ways.
That actually, yeah, that's a good segue into my next question. You've highlighted obviously the biggest drivers of ETFs, even going before active kind of hit that renaissance, was the tax treatment, the structural advantages. But how do you think advisors should evaluate true active value beyond that wrapper efficiency?
Do you want to actually evaluate true active value, or are you really looking for what is providing you the best best risk-adjusted post-tax returns for the money that you're managing, right? And what are you trying to achieve? Like, and I actually think that's a problem. Like, I think today people still have buckets, right? They have their passive bucket and they have their active bucket. And even for Northern, when we sell our quality low volatility strategy, for example, it's an index-based product. But if we go to many of the gatekeepers on the street, even though it tracks an index, since it's not one of the core indexes that they think of, like an S&P or a Russell 1, they think of it as active, right? And there's been this debate going on forever. And so, but you have advisors. So when you go to advisors and when you're trying to sell the product, some advisors say, oh, it's an index-based product. I analyze it with my index funds and it goes in bucket A. And therefore it goes to this research analyst. And others will say, well, it's not the S&P, it's not the Russell 1, it's based on a proprietary index, quantitative index. It goes in bucket B and it goes to my active analyst, right? I actually think that's sort of like creating confusion for no reason, right? What we should be doing is let's look at this strategy, let's ignore this active passive because the lines have become so blurred. And let's see what the risk adjusted returns look like based on what we're trying to achieve and what do they look like post tax, which is becoming more and more important in the ETF structure as you see sort of multiple strategies that look alike. They're doing the same things. The high income funds are important here, but they all have different, depending on how you trade the options or what you're doing, you're going to have different tax treatment on the funds. So you need to think about that as well. So my view from here is, like, to get back to your question, like, I think we should sort of decrease the value of this assessment of whether it's active and passive and elevate the importance of risk-adjusted returns and post-tax outcomes, like what's really being delivered. That's kind of the way I think about that.
Yeah, you actually just answered my next
Oh,
question.
sorry.
Was, no, it's all good. Like, obviously, like, that's an issue with advisors, but, my question was really like, what mistakes you see managers making kind of, confusing beta with true active skill. And so,
Yeah,
you just answered it. So
it's really hard for them, right? Like, I mean, think about even the evolution of the last 15 years or so. I came into the industry, or when I started on the issuance side. Originally, I was a trader and I was a market maker in ETFs, and then I switched over to the issuance side, and we were selling what we called smart beta. And
Mhm.
I mean, what is smart beta? There's beta, and then there's now smart beta. It's better beta, right? Like, it's a different way of indexing. It's really like many people think of it as an active overlay on a traditional index, right? And then we decided that smart beta was getting crowded, and we started calling it modern alpha, right? Which harkened back to the days of active managers generating real true alpha, and we called it modern alpha because that's what systems are doing today. Like, it is really hard for advisors. You want to try and sort of get past the marketing, right? That's where I go with that answer that I was giving you, is like, you got to get past all the marketing. And even today, like financial services, there are some like leaders of marketing that have become big providers of money management services in financial services, right? And it is hard for advisors. Look, advisors are on board, they love it, but it's hard for them to really distinguish what's going on in the strategies that are underneath all this marketing, you know?
Yeah, it's a lot. I come from a background starting in an RIA, and so I get it. And so there's a lot to deal with.
Yeah.
But I do want to kind of get into, what's especially new with Northern Trust. You kind of leaned into fixed income innovation, with the distributing ladder strategies. What research or insight led you to believe the market needed this versus, say, traditional fixed income active products?
Yeah, it's a great question. So what we're doing and what I believe, so there are always lots of questions like, there's 4,000 plus ETFs, isn't it enough? Like, we've been answering that same question for 20 years already, right? When there were 150 ETFs, people were like, was it 100 enough? Why do we need 150? You know, and And then all of these new things keep coming out, new ways to provide. I think of ETFs as being able to even provide bespoke solutions for investors in all of these different ways that we couldn't do before. So when we think about distributing ladders, to me, it goes a little bit back to my roots. Have you ever heard of the FIRE movement? I don't know if you have
Oh, no,
done any
I know the
reading on
fire
that.
move. Yeah, yeah,
Like
yeah. I've
it's
heard of
called
it.
financial independence, retire early,
Yep.
right? So I've been I am not retiring early by any means, but I've been a financial independence disciple for many years, right? And this community has been growing and growing, and it coincides with what I think of as even the growth of individual investors, right? Like the ability to almost replicate a Bloomberg or a, on your own desktop and get that information and get all the information and make your own investment decisions has grown rapidly, right? The markets have changed. So individual investors and all investors, even advisors, have so much more power around investing. So when you think about this concept of what I noticed with FIRE investors is one of the things they do is they use websites like Tips Ladders, for example, and they go out and they plug in what they want to achieve, and Tips Ladders spits out a list of, say they want a 20, they have a 30-year time horizon, they want a 30-year ladder. Tips Ladders kicks out like a 30 different bonds or 45 different bonds that you'd have to buy to build this ladder. And there are some investors that are actually going out there and slogging through it. And I always thought, wow, this is a complicated way to manage money. And then I got to Northern and I learned about our wealth business. And our wealth business is something that I think of as unique in the industry. We practice something called goals-based investing, right? Where we take an investor and we don't start with, okay, you've got all this money, here's how we're going to invest it. We start with this concept of, okay, you've got all this money. Why did you go out and why did you get all this? Why did you work so hard and generate all this money? What do you want to do with it, right? What are your goals? And when you start to think about money in those terms, then you realize, well, I want to send my kids to college and I have always wanted to give back. So I want to spend $100,000 a year and give back to my favorite charity, over the next 10 years or something like that. And I looked at it and we looked at that sort of concept and we married it to this idea that you can do lots of different things in active ETFs. Can't we bring it together and make it easier for investor to manage their money towards goals? That's exactly what distributing ladders are. So if you think about a traditional ladder, either when you build it on your own or when you build it in an ETF, it's perpetual. Generally, when you buy it in an ETF, it's perpetual. So you buy the ladder, the first year matures, and then they buy the next farthest out year, right? And the ladder just goes on forever. And if you want to use that money for something, uh, you have to go make a sale. And that sale, depending on what's underneath and what's happening, you could generate a gain. It's complicated. You have to remember when to do it. You have to figure out what to do. And we looked at this and we were like, well, we can marry the flexibility of an active ETF structure with this concept that people don't just want their money invested forever. Sometimes they want to use it for their goals, and we could give it back to them in a tax efficient way. And and this was not easy, right? Like this is sort of blasphemy in the fund world that you want to launch a fund that actually winds up at some point in time, right? Our 5-year distributing ladder product will wind up in 5 years because we'll have given you all your money back, right? And that's a hard concept for some people to get around. But for investors, they're like, hey, wait a minute, that's exactly what I need. Hypothetically, if I have like $1 million and I want to give away 100 every year, you'll just give me my 100 back. And I invest $1 million over the next 10 years, you'll give me 100 back each year. I don't have to do anything. I don't have to potentially create gains. I don't have to pay commissions on sales, whatever it is. You give it back to me as a return of capital, and I can use it for my goal. I can give it to my charity, things like that. This was just sort of, it just struck, right? And it struck us as like, why doesn't this exist? why don't investors have this yet? It's been a little slower for investors to understand that, and the interest is really interesting, but it's hard for people to understand. They have to get their heads around how it works. Sorry, that was a
I mean,
long answer, David. I apologize.
no, it was great. It's certainly a unique idea for retirement income and cash flow management. How do you think it balances with traditional active bond funds in a portfolio?
Yeah, so let's go back to that sort of the concept of active and what are we trying to do? In this case, right, with the distributing ladder, what is our primary goal and what is the goal of the investor? Well, they want to use their capital for something. So first and foremost, our primary goal is preserve their capital. Make sure that if you've invested $1 million for a 10-year product or a 20-year product or 30-year product, you're getting $1 million back, right? That is like our unwritten code of what the investor wants and what we want to deliver. And that's where we start. Then we use the active piece only in as much as we're trying to generate as much yield in each of the rungs that we can, again, while not sacrificing at all that concept that our primary stewardship goal is returning a piece of the capital to investors, whatever tenor they're on each year. So for us, it's like the strategy is active because within each of the rungs, within the parameters that we set out of the bonds that we will invest in, we have some flexibility, but our primary goal is maintaining and ensuring that when you invest in these products, you get your capital back first and foremost. You may give up 10 basis points for that because capital return is our priority, but we think it's worthwhile. And at the same time, we're trying to get you as much yield as we possibly can.
So do you think there's a trade-off between the alpha versus the predictable cash flows?
I always do. And I mean, look, I think that's the industry, right? Like there's every time you go up a notch in potential alpha, you go down a notch in we call it increased risk, but you really go down a notch in predictability of that return, right? Like volatility increases with increases in alpha. So what's happening here is again, it gets back to where I think advisors and for Northern advisors, if somebody comes to us and says, I've got, I'm 62, I'm retiring at 72, I need an income over the next 10 years until I can start taking Social Security. I've got this $1 million. If I spend $100,000 a year, so we give them a 10-year product. You think about a 10-year distributing ladder, it'll give them $100,000 each year to spend. That's more important, right? If we showed up in year 10 and said, we've only got $60,000 left. So this year, that Alaska cruise you were thinking about, sorry, you've got to nix that, right? Like, if you want us to have that conversation with your wife, we can, but I know it's going to be a hard one, right? We never want to be in that position, right? So they're not asking us, they're not at the end of that year saying, oh, how come I only generated 10 bips versus 15 bips in my interest? What they're thanking us for is the fact that we securely stewarded their capital through the process and helped them achieve their goals. That's way more important, right? That's what goals-based investing is all about. I actually think it's it's something you can go back to it. It's something I had internalized as a person for years. Like when I got into the ETF industry, 1998, and when I really got my head around ETFs, it was roughly 2000, and I was like, yeah, like these make sense. When I leave the office, I was working at Bear Stearns at the time. I'm an investor, and investors deserve, fair deals, transparency, lower fees. And that was really what got me hooked on ETFs back then. And we're still on this. And now we're just using the structure to give people better and better products to help them manage their financial lives. That's the way I think of these.
That definitely makes sense. If we take a step back and just think of fixed income active strategies in general and, the current macro environment, I do a quarterly report called the Beat Report by Bloomberg, where I look at the percentage of managers outperforming. And one of the things I noticed last quarter and, just last year in general, active bond managers really struggled than in past. And so there's some debate of whether alpha opportunities are as available as they were, years ago. How do you adjust risk appetite versus, I guess, income objectives? How do you think about that?
Can I ask you a question first on that
Sure.
regarding the question? The Do you have the stats on non-fixed income managers on how many active managers outperform their bench? I don't remember what the current thinking is. Is it like
For
15%?
equity managers, or
Yeah, for equity managers.
it's around 30% when I look at it.
It's
It kind of debates, but it's always down,
it's
much lower than income.
much lower than it was always,
Yeah.
right? Like it used to be higher and
Yeah.
it's been dropping annually, right? And it's
Been dropping steadily. I mean, if you go back to the 90s, it was obviously much higher. The last 10 years or so, it's been kind of steady, lowish.
in the fixed income space, let's apply that thinking to what we're seeing happening in the markets. And let's talk about the ETF industry as a whole for a minute. The fixed income markets, much bigger than the equity markets. Except if you look at the ETF world, equity ETFs much more prevalent than many more assets in equity ETFs than fixed income ETFs, right? Part of it is structural, right? Like the fixed income markets were, I guess I would say, outdated technologically for many years. And I actually think that fixed income ETFs are driving automation in the fixed income space. And it's still, the fixed income space is complicated, right? But every day that automation becomes more prevalent, the systems can do more of the work, and it becomes harder and harder for active managers, those real, a bond selector, to add anything over what the systems can do. I read an interesting article this past week. It was talking about how AI can replicate almost 70% of what active managers can do. And I was
Yeah, I saw that.
Yeah, so it's pretty crazy. I was thinking about it this way, and this is like a very simple example in my head of like, how do I think about that? So you have 5 stocks, and you have an active manager, and you have an AI. And the AI and the active manager on 4 of those stocks, they basically will pick the same 4 stocks because the whatever the active manager is using, whatever system it was, it can be replicated by AI. Whatever numbers that active manager was doing, it can be figured out by AI. And therefore it can replicate roughly 80%, 70 or 80% of that 5th stock. This is really, I was like, what is it about that 5th stock? And what it is about that 5th selection, that piece of active management, in my mind, and a lot of people are going to hate me for this, is I think the active manager gets up, it's a sunny, warm day, and that 5th stock that was close to being included in the system, and that the AI would never include because it's only a computer, the active manager feels generous that day, and they're like, you know what, we're going to put this 5th stock in. Or it's been 16 inches of snow like we're more used to nowadays, and they're like, there is no way, that stock is almost there, but I'm not doing it. They're not getting in, right? Like that component of active management is something that will never be replicated exactly by the machines, by AI, I think. So there's always a piece, but it gets smaller and smaller every year, right? Like, and that's what's happening here. And I think that even as we continue to automate the fixed income markets, and we have better analysis, and we have, it's going to be tougher and tougher to do that. And in order to generate sort of what you think of as alpha returns, you're going to have to increase your risk appetite to try and take those risks. And I think for the most part, what you're seeing is it's not a good trade-off for investors, really.
Yeah, makes sense. Yep.
So that's my simpleton's explanation of what I think is happening in the world. And we saw, it's like we kind of saw it with equities. And I think it rhymes.
No, definitely. And so I do want to ask you, just from like a product design standpoint, when you're looking at advisor adoption of active ETFs, because I mean, that's where a lot of firms are looking for is, the advisor world, because then you get the, the retail clients. What type of feedback have you kind of gotten from them and kind of incorporated into new products? especially around distribution, or even transparency preferences?
Yeah, well, look, advisors have been voting with their dollars for years that transparency matters. And I still think it's a core tenet of investing. I used to laugh. So I really sort of laughed at this concept that, before 6C11 and before active ETFs started really growing fast, a lot of the active management space would say, we do not want to make our portfolios transparent to investors because they will just run out and go replicate them themselves. I mean, don't they realize people have jobs to do? They have to go be teachers and they have to build buildings, and they don't have time to go doing replicating portfolios. All they want is a fair trade, right? Like they want a fair shot. So I thought that was a sort of a red herring, right? And I think advisors are saying that with their dollars that they invest right now. Transparency is key, right? Like that's what's driving. And I think if you go back to '08, or you sort of look at what's happening now with private equity valuations, right? Transparency is always key. I never believed in non-transparent active ETFs. I didn't think there was a solution for them. There's a de minimis amount of capital invested in them because there's always somebody somewhere that wants to invest that way. But really, it's de minimis in terms of the whole ETF boom. And I think the future is all about this sort of transparency, and the the sort of investors just, like I say, they're smarter, or they have more access, and they just want to know what they're getting. I think it's a key to investing today.
No, I totally agree. I was actually on the team. Not sure if you remember next year's,
Of
but
course.
it was the first one that was trying to launch with the non-transparent, and just I think across the board, non-transparent. Just it's not getting the assets, and I think a lot of firms are realizing that, and so I think it's mainly going to be transparency. And
I
we
love it.
talked about the distribution ladder ETFs,
Yeah.
but are there anything else? What other are you seeing as kind of like active adoption gaps that your team is looking to address?
Well, look, let me just say, like, I love the fact that they were innovating on non-transparent, right? Like the innovation that we've seen over 20 years in financial instruments due to the ETF industry is astounding. Like if you really look at it, it's amazing. And without somebody trying to launch non-transparent active ETFs, we might not be here today where we are with the growth of active ETFs, right? Like all these things push us forward, right? Like we are,
Yes, good point.
we're building the bedrock of the investment products of the future, I think. We actually launched a set of index products at the same time as distributing ladders focused on the muni market. And the muni market is like those indexes are so complicated and big, right? Like this is a
Yep.
market where you could potentially, like, it seemed right that there should be a set of core indexes, right? Like your go-to indexes in the muni market that are priced extremely reasonable and things like that. And then the next step is that for those that want to go out there and really pursue a higher yield in that space, I could see some more active strategies even in that space coming online in the future, right? Like I think the tax advantages of those funds are critical for probably the most important thing for investors are after tax returns, like I say. So taxes are becoming a bigger and bigger bite out of your portfolio all the time. So I think the muni space is actually ripe for a lot more sort of in the area of active, even beyond what we've built with the indexes as your core portfolios.
No, be interesting to watch.
Yeah.
So my last question is, I guess, more backwards looking. And so you've led teams through structural shifts from Wisdom Tree to crypto at Gemini, and now you're at Northern Trust. How has that kind of cross market experience changed how you think about innovation in active ETFs?
Yeah, it's I've always loved technology, and I actually think of ETFs in general as a technological solution, right, for investors. And the I feel like I have gone from one technology firm. I was at Bear Stearns, and I was actually when I started at Bear Stearns, I was I was in charge of their technology. I bought all their computers for their back office in the early days, right? When I went to WisdomTree ran more like a fintech than a financial services firm. We didn't have all of the complications of traditional asset managers, right? If you think about, big asset managers, they're selling direct indexing, they're selling SMAs, they're selling mutual funds and ETFs. There's so much internal conflict around what they have to do. I thought of WisdomTree as like a technological solution to that. We do one thing, we do it well, and it's a technology. I was blown away when I moved on to a firm like Gemini. Like they took like startup technology to a new degree that I hadn't experienced before. It was really a tech firm with a business arm. And all of it was, one of the things I was focusing on, even in the crypto space early on, before we got approval for the crypto ETFs, was bringing crypto ETFs to market, right? And it was marrying the technology that we had at Gemini to custody and clear crypto to the ETF structure that I understood really well. And we were helping, provide that back end to investors. And now today we see it as well. Like I think of what we're doing on the ETF side and what we're building at Northern Trust, we're like building, it's almost like a small technology unit within the firm where we really push the limits if you think about distribution, we use so much technology in our distribution on the building of products. When we thought about building the distributing ladders, right? Like how are we going to manage, if you think about like 30-year ladders of munis and tips, it is a technological sort of work of art that we can manage those funds in all sizes, providing intraday transparency and liquidity for investors. This is like, it's complicated and we're making it easier for investors. So yeah, it's like, I feel like my career through these places has always been stepping stone, and utilizing each piece, I've sort of leaned on it to figure out where we're going to go next. I think that's what's been happening. It's been great. Look, I've been so lucky, right? 30 years in financial services, mostly in New York. It's been an amazing experience. I can't be thankful enough, really.
I appreciate it. Thank you for sharing. Unfortunately, we do have to end here, but thank you, Dave. I really enjoyed this discussion. It was fun.
Yeah, it was great. Thanks for having me on, David. It's a great show. I love it. So,
thank you. And I also want to thank our listeners. If you like the episode, please share it, subscribe, and leave a review. And if you'd like to see more of our research on the terminal, go to BI Fund Go for fun and active research. Until our next episode, this is David Cohne with Inside Active.
Ever feel like your bedroom's shrinking? Don't worry, you don't have to sell your favorite things to make space. With IKEA Bedroom Storage Solutions, think dressers, wardrobes, full closet systems, even storage boxes. You can keep it all. Your vintage band tees? Safe. Those limited edition sneakers? Plenty of room. And yes, your childhood teddy bear gets a spot too. Don't sell what you love, store it instead with IKEA Bedroom Storage Solutions. Shop now at ikea.us/bedroom storage.
The news doesn't stop on the weekends.
Context changes constantly. And now Bloomberg is the place to stay on top of it all.
Hi, I'm David Gura. Join us every Saturday and Sunday for the new Bloomberg This Weekend.
I'm Christina Ruffini. We'll bring you the latest headlines, in-depth analysis, and big interviews. All the stories that hit home on your days off. And I'm Lisa Mateo. Watch and listen to Bloomberg This Weekend for thoughtful, enlightening conversations about business, lifestyle, people, and culture.
On Saturday mornings, we put the past week's events into context, examining what happened in the markets and the world.
Then on Sundays, we speak with journalists, columnists, and key political figures to prepare you for the week ahead. Join us as soon as you wake up and bring us with you wherever your weekend plans take you.
Watch us on Bloomberg Television, listen on Bloomberg Radio, stream the show live on the Bloomberg Business app, or listen to the podcast.
That's Bloomberg This Weekend, Saturdays and Sundays starting at 7 a.m. Eastern. Make us part of your weekend routine on Bloomberg Television, radio, and wherever you get your podcasts.